Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to the midweek edition of Money Talk. It's Wednesday the 19th of August. This is Peter Lewis with an update on the day's business and finance news from around the Asia Pacific region. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's headlines, Donald Trump said he won't try to revive a stalled truce with Iran, leaving the Middle East conflict and the tussle for control of the Strait of Hormuz in limbo. A cargo vessel was struck by a projectile while transiting the strait yesterday, underscoring the persistent danger to shipping as the US-Iran ceasefire collapsed and both sides hardened their positions. Donald Trump's decision to scale back joint military exercises with South Korea has deepened concerns about US reliability among Indo-Pacific allies, who were already nervous about his shifting posture towards Taiwan and the broader regional security architecture. Hours before the drills were set to begin, Trump declared they would send a hostile message to Pyongyang, echoing North Korea's long-standing claim that the exercises are a rehearsal for a war of aggression. The decision comes 5 weeks before Chinese President Xi Jinping is expected to visit Washington. Investors are increasingly demanding a higher premium for long-dated government bonds on concern inflation is above target and fiscal deficits are hard to contain. Yields on 30-year US Treasuries rose to 5.33% this week, the highest since 2007, while French borrowing costs hit the loftiest since 2008, and their German peers traded at 2011 levels. Equivalent gilt yields are approaching 6% in the UK. In Asia, bonds in Australia and New Zealand dropped Tuesday, while Japan's 10-year yields climbed to the highest since 1996 amid a global sell-off that's pushing up borrowing costs. And Japan's 30-year yields rose 6 basis points to 4.14% on Tuesday, close to their highest ever level. In China, however, yields are moving in the opposite direction as weak economic growth and consumer spending push investors into the country's sovereign debt. Yields on China's 10-year government bonds slipped 1 basis point Tuesday to 1.67%, their lowest level since July last year. With their analysis of that this morning are Simon Kavanagh, partner at BDA Partners, and John Schofield, managing director of Tempus Investment. With a view from Japan is Tokyo-based Japan strategist Nick Smith. And if you want to get in touch, then please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Tuesday, US stocks fell as bond yields pushed further to multi-decade highs and oil prices extended their climb, draining traders' appetite for risk assets. The S&P 500 notched a third straight day of losses. The broad market index declined 0.7% to 7,692. The Dow shed 116 points, that's 0.2%, and closed at 53,343. The Nasdaq Composite was down 1.3% to end at 26,290. Interest rate sensitive artificial intelligence linked stocks bore the brunt of the selling Tuesday. The Philadelphia Semiconductor Index, which tracks major US chip companies, dropped 5%. Attention remains firmly on the bond market. Yields on 30-year government bonds continue to climb across the world, with those on treasuries up 1 basis point to 5.32% at one stage, the highest since June 2007. Yields later backed up, with the 30-year settling at 5.29%. In the currency markets, the dollar edged up after dropping to the lowest level since May on Monday. The US dollar index rose less than 0.1% to 99.67. The Japanese yen hovered around 159.5 yen against the dollar on Tuesday. The offshore Chinese yuan was 0.1% weaker at 6.75 renminbi per dollar. Spot gold settled 1.8% lower at $4,339 an ounce. And Brent crude oil rose 0.2% to $91.02 a barrel Tuesday after Donald Trump said he wasn't interested in extending the expiring agreements with Iran. Meanwhile, the pump price of diesel in the US, which has an essential role in powering industry and agriculture, hit $5.47 a gallon on Tuesday, approaching its all-time high of $5.82. Bitcoin was trading at $65,600, up 2% over the past 24 hours. In the Asia-Pacific region, stocks and bonds were both lower Tuesday. MSCI's regional gauge fell 1%. The Kospi index in South Korea gave up an advance of 3.4% to finish 1.6% lower at 6,870 by the close. The Nikkei 225 in Japan tumbled 2.5%, ending the day at 67,461. China markets were mixed. Mainland China's CSI 300 declined 0.33% to 4,726. Hong Kong's Hang Seng Index was little changed, ending the day up 18 points at 25,471. Futures markets around the region pointing sharply lower this morning. The Hang Seng Index in Hong Kong projected to start the day down 0.4%. Looks like the Nikkei 225 in Japan is going to slump around 2.1% at the open.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us, first of all, John Schofield, Managing Director of Tempus Investment up in Hong Kong. Morning, John.
Yes, hello, good morning, Peter.
And also joining us from Hong Kong, Simon Kavanagh, partner at BDA Partners. Morning to you, Simon.
Morning, Peter. Morning, John.
Now, as you heard in the headlines, sovereign borrowing rates are surging around the world with yields on 30-year US Treasuries, French borrowing costs and German peers rising to the highest levels in years. Yields on 30-year US Treasuries rose to the highest since 2007 this week, while French borrowing costs hit the loftiest since 2008. Their German peers traded at 2011 levels. Equivalent gilt yields are approaching 6% in the UK, and similar maturity Japanese ones are close to their all-time highs. So, Simon, what is going on? Why are we seeing this surge in yields all around the world? Is it the same thing everywhere, or are they specifics to each of the markets? What's happening?
I think there's some common themes, and the one I feel is biggest is this ongoing fiscal deficits and essentially the long-term deterioration in government finances. You had the statistic there where for the US, interest costs as a percentage of GDP have jumped from just over 2% of GDP, and they're on track to hit 4.6%, I think it was, by 2036. So there's an enormous amount of sort of revenue, tax revenue, that is now just going to service debt. And there's no sign that the governments are looking at getting essentially their books under control, balancing the budget, and it's a sort of continued deterioration. No one sees an end in sight, and I think people are becoming a little wary in terms of the longer durations. I don't think I think we will get inflation under control in the sort of short term. I think the central banks are very much focused on that, but I feel that this is more of a longer term concern over government finances.
Okay, well, we'll come on to some of those points in a moment, dig further into them. John, what are your thoughts on this? What are the reasons why we're seeing these surging bond yields around the world, but in particular in G7 countries, in the US, Japan, France, Germany, UK?
Yeah. Yes, a convergence of the factors, some of which Simon has just touched on. And clearly, at the end of the day, it's a supply and demand thing, and the insatiable supply, I should say, that's probably the wrong verb to use, but the ongoing heavy supply of bonds is definitely combined with, by the way, this new surge in demand for borrowing from the corporate sector, particularly the AI build out, is putting a lot of pressure on yields. One factor is that what the unusual factor I think is that the yield curve has steepened. So very much the short rates, the central banks are very anxious to keep the lid on and use every excuse they can to not to start hiking rates. The ECB having been a notable exception. Another one being Australia. That you may have seen earlier, during the spring, Australia had a couple of base rate hikes. I think the market now is signaling a lot of concern that the central bank, particularly US and UK being the two prime suspects, are not actually serious about fighting inflation or getting inflation back under, back down to target. It's been sort of bubbling along in this sort of around 3% in both cases. And they keep saying, "Oh well," I think the Bank of England guy said he said we expect inflation to come back into target in 2028. And that's just outrageous after 5 years of above our target. But they know, unfortunately, it will inevitably slow the economy and possibly even prick the bubble if they do. If they do start hiking rates.
I mean, you've both made the same point about these ever-increasing deficits. But Simon, this has been going on for years, hasn't it? Deficits have been getting higher and higher as a percentage of GDP. And we've wondered when that will become a problem for the markets, and in particular, where are the bond vigilantes who are supposed to be looking at this, and it hasn't happened. Why suddenly now? Have we sort of suddenly reached a tipping point, Simon, for this, where this is now at levels where it's a problem?
Well, we'll see. I mean, I think certainly at these historic highs, things aren't sustainable. But as John says, there's partly a demand and supply problem. We've seen China selling its stock of US Treasuries to bring more money back home. So that you've got a seller there. There's also with this sort of AI data center rollout. I mean, to give an idea of the capex that's there was that story about sort of the top nine. Sort of the Magnificent Seven plus two, I don't know which two those are, 3 trillion in off-balance sheet sort of borrowings that will have to come home to roost when they set up new data centers. And I mean, that's 3 trillion against the US total debt of 40. So, I mean, it's a pretty significant amount that'll need to be funded. And so that's pulling some money away from treasuries as well. I don't think there's a single reason. I mean, the weightings to equities still generally, I think, overweight. Various research and surveys have shown that. So people are still on the kind of the bull bandwagon there. So there's a lack of demand for US Treasuries, and that'll be driving yields up. But at some point, I mean, I don't know if there's a particular catalyst, but essentially the fiscal position of all the G7 economies continues to deteriorate. As John says, yep, they have inflation targets, but they're kind of in no rush they'll say they'll get there, but it's kind of when, and they're happy to drift along at above 2% for a few years, it seems, which isn't giving people much comfort. So I think it's a number of factors, but the short-term yields remain relatively low. So I think people are just taking a very short-term view, and they're worried about the long-term future.
John, are we at levels where this is a problem, where the financing costs at these sort of yields make it very difficult for governments to sort of refinance into longer dated sort of bonds?
Yes. I don't know about the tipping point. I mean, just going on to the point about the stock market, I see some debate about at what level do these high interest rates, long-term interest rates, start to affect the appetite people to buy equities, especially equities which have very low, high multiples and low cash flow coming in. So the duration, long duration, what are the discount rates for the net present values? They're going up all the time. At some point, that will cause a sell-off, I think, in the stocks, particularly the tech sector and so on. And indeed, yesterday's sort of reversals on the and petering out of the rallies in Nasdaq, Kospi, Taiwan, and so on, to me signal the top of the partial recovery we've seen from the May-June sell-off. So I think we're now probably heading into a second down leg for the sector globally, and that might be enough to sort of pause the rout in the bond markets as people start to think, well, maybe I can get guaranteed 5% for 10 years, and that doesn't look too bad, even with inflation at 3%.
Yeah.
So there's a kind of interactivity there between the stocks and bond level valuations.
Yeah, because you've got essentially your risk-free rate that people look at from an investment point of view, and that's increasing as yields increase. So you need quite a premium to say I'm going to forego that, and I'm going to put it into equities that, as John says, the yields are at historic low on equities, and it's all a capital gain play. And at some point people go, this isn't worth the risk.
We've got to consider Japan, haven't we? Japan's 30-year yields are close to their highest ever level. Yesterday, they closed at 4.14%. 10-year yields almost at 3%, which is the highest level since 1996. Now, this is significant, isn't it? Because the Japanese yen is the funding currency for global asset managers. It's been funding basically global markets for quite a long time through the carry trade. People borrow, investors, hedge funds borrow in Japanese yen, then swap that into the US dollars and go and put it into the markets. So if this carry trade stops or now starts to unwind because, Japanese yields are rising now, it's no longer such a cheap funding currency. Does this have significant consequences for global markets?
The Japan situation is really interesting. In some ways it's similar, in other ways it's different. I think you're right. I think Japan the highest or the second highest holder of US treasuries?
It's the highest now. It is the highest.
It is the highest.
UK and China.
We saw with this a rather strange intervention on the level of the yen that was clearly influenced by concern that Japan might have to start selling down its US treasuries in order to defend the yen. But otherwise, it's the extreme example of keeping interest rates artificially low and still proving reluctant to get it. While the long end of the bond market has the yields have soared. In that case, soared is not an exaggeration. So now you've got I think it must be the steepest yield curve in the world now, 1% at the short end to 4% plus at the long end. And so that's where up to now the Japan government have not had any problem issuing bonds, but I wonder if that's and they do have this very high GDP ratio, GDP to debt to GDP ratio to 200% or something like that. So is Japan going to hike short-term rates finally to defend the yen?
It needs more than one, though, doesn't it? It's just raising interest rates once isn't going to be enough.
Yeah, well, it needs to be. I think I said it was either 2 or 3 years ago on this podcast that they need to hike short-term rates to 2%. As soon as possible to stabilize.
That was 2 years ago.
That was a yen first hit 160. I think
Yeah.
Was it 2023, something like that? So they're still back at. So it looks like on the yen front, they're quite happy. They're just trying to stabilize it just below 160. But if it breaks 160 to the upside, then that will cause a problem.
Mm.
The
I think
carry
there's
trade
no
people.
conviction at the moment that they're trying to get inflation underway. I mean, a lot of it's been driven by Hormuz and the oil price, and Japan obviously being a massive importer of energy costs. But what was it, the producer price inflation that came out last week at sort of 7%? So there's a real pressure on
Yes,
Japan
yeah,
corporate
I think
manufacturing, and
yeah they've
yeah,
got.
back to Japan, no
I
rate
mean,
increase in sight.
we see intermittently these sort of breaks of protests about the price of rice having gone up. I think that sort of food and general inflation is above 2% now, which was always that said that was always their target. So again, you've got a government that is reluctant to hike short-term interest rates because they think it will depress the economy.
If you're a Japanese
Um,
pension fund or life insurance company or just a Japanese investor in general, would you now be tempted to repatriate assets back to Japan? And if so, isn't that going to have huge consequences for global markets in terms of capital flows?
it would if they did. Yes, certainly it would have a tremendous consequence if they did that. But I doubt very much they would do that because what are they going to do with the money? Um, unless unless interest rate hiked and then the yen starts to firm up, then alternative investments look more viable.
There's another aspect to all of this, which is that China's bond yields are going in the opposite direction. They're now at their lowest level in more than a year. The 10-year Chinese government bond yield is at 1.67%. That's the lowest level since July. Is this simply because of the deteriorating economic outlook in China, Simon?
Yes, I think so. I think there's still huge structural problems in China, and it needs to, I mean, there's a whole number of initiatives it could try and do to reinvigorate and restructure and rebalance the economy, but they tinker around the edges, and there doesn't seem to be any wholesale effort. So yes, I think very much so. Low interest rates there, they certainly couldn't raise them. They need to do whatever they can to stimulate investment, and I mean, private credit had shrunk to a significant low in one of the recent data points, and the last thing you want to do there is then raise interest rates on top of that. So yeah, they need people to spend, they need people to invest, they need people to feel confident about the future, and that's not happening at the moment.
Has the PBOC got to cut rates in China? I know they're quite reluctant to do it, aren't they? But have they got to go and ease monetary policy? Because the last set of data that we had for July out of China was pretty grim, wasn't it? The property market is still slumping. Investment in property was down 19%. Businesses, households just don't want to seem to invest at all at the moment. As you mentioned, the loan data, we saw the biggest monthly decline on record in China's new loans. It's not a good sign, is it?
No, it's not. And I mean, it's interest rates are already low, so the impact of cutting them is reduced. There isn't sort of not really the same psychological impact because everyone knows that you're cutting it because things are in a bad state. There's been a lot of talk about the sort of net interest margins that the banks make, their spread, and that obviously gets reduced if interest rates come down. The banks themselves are in, I think, a fairly precarious state with a lot of this real estate debt. And if some of the parts of the manufacturing economy and people linked to the EV sector and some of these sectors where just because there's massive competition, there's very little profitability, I think the banks have quite a lot of risks, and they're not going to want to absorb a further cut in their margins. So that'll be something that PBOC has to take into account as well.
I mean, John, this is stark contrast, isn't it, to the G7 countries? Falling bond yields here, pressure on the PBOC to cut rates, whereas elsewhere it's the opposite.
Yes, extraordinary. I think, by the way, I don't think there's any point in them cutting rates. I think that's the proverbial pushing on a piece of string thing at this stage of the game. As Simon points out, you've got such low, it hardly makes any difference, and all it does is penalise savers and people like that, and where we need to get people feeling they can put their money to work. But it's the mirror image of the supply demand problem in the West, in G7. Here you've got massive supply but no demand, at least internally. And the constant export drive, sector after sector, seeking world domination, is just depressing the domestic economy. Again, we've discussed many times why the need to get domestic demand up, consumers spending and so on, but nothing happens.
Have they got to do something then to get domestic demand going? Have they got to do something finally about the property market and provide some demand from the central governments in order to try and stabilise the property market? Are we not going to see an improvement in domestic demand until they take the bit between their teeth and deal with the property market?
Yeah, I mean, I've been saying for a long time they need to really take a hands-on approach to the property market. You've got to, you can't have these zombie real estate firms continuing. You can't be finishing properties that really are no longer wanted anymore and are worth significantly less than they were when the individuals that put down the deposits to buy them. They should give the deposits back. They should let these real estate developers get wound up. They should, if they have to, they need to inject money into the banks to keep them solvent or kind of wrap them up and consolidate the banks. And then they need to look at how all the local municipal governments fund themselves, because we got into this mess because they were a huge source of their revenue at a local level was from property sales. And that's just not sort of sustainable or achievable anymore. So how else are we going to sort of run local governments? That's something that they need to address on the property side of things. And then there's a host of, again, which sort of require big decisions from Beijing. I think the social safety net needs to be improved so people at sort of lower income levels aren't sort of concerned and worried about having to save everything, and they need to provide some incentives to boost youth employment, which youth unemployment remains very high, and I think that has a big knock-on psychological effect on families, because you'll have families sort of supporting children that really should be off employed. You'll have children that are don't have a sort of rosy outlook for the future because there are no jobs for them. And yeah, it's a problem that needs to be fixed, and it's not going to be fixed at the local level. It needs to be fixed by Beijing, and it's not going to be fixed by tinkering with sort of fiscal things like tax rates and interest rates.
John, where do you think the growth stimulus is going to come from? You mentioned China can't keep relying on, becoming dominant in exports. I mean, at the moment, it has a trade surplus with almost every country in the world and in almost every sector as well. Presumably, that can't go on forever. So it's got to find some new growth drivers.
Well, they should be recycling I think there has to be some form of fiscal stimulus, i.e., but driven down to to local level, to individual level, where I mean, there was talk, I think during COVID, was it, of a cash handout, a little bit like Hong Kong did, um, but that didn't go anywhere,
Well, I think
if I
all
remember
those
rightly.
measures are just sort of so
Yeah,
one-off.
tinkery,
I mean,
tinkery.
give
Yeah,
them cash, they'll spend it. Great. And then sort of you have a few good quarters and then it's out of the system again. It's like
yeah,
the
yeah.
trade-ins for
It's got to be something sustained. Yeah.
yeah, trade-ins for sort of
Um,
white goods. Yes, it works, but after a while, everyone's got a new washing machine and everyone's got their electric vehicle, which
yeah,
is why those EV sales dropped so much.
Mm.
It's kind of saturation, but they haven't actually fixed the underlying problems. And I mean, it's a really difficult problem to fix. I don't envy
yeah,
them at all, but um, it's kind of it's kind of the job of
yeah,
being in government.
yeah.
Mm.
I mean, the relationship between the centre and the regional governments is an interesting one. I hadn't fully appreciated how much the strategy, of course, and all these 5-year plans comes top down from Beijing, but the implementation of it is up to each regional government, and they all compete with each other massively to build more factories in this and that, and as we've seen, they did in the property sector as well, quite disastrously. So so the local governments really don't have to, we need to have more tax raising powers, but also more, to embed the social safety net, as you described, and things like that. So there needs to be a whole restructuring. But unfortunately, it sounds more like saying, well, they should convert to a Western style economy.
Yeah. I mean, in the meantime, I mean, Beijing's trying to raise taxes, isn't it? It's trying to chase people who have offshore trusts, getting them to pay back tax on that. And then at the same time, Hong Kong is trying to cut taxes and have a
Yes,
sort of, it all seems a bit at odds with each other. What do you make of that?
tax the rich.
It's a
Yeah,
bit like that, isn't
that's a
it?
good old socialist. Oh. Yeah, well, I mean, I guess there's something in it. There's of course huge inequality, uh, wealth inequality in China, as there is in many other countries, and as we see from these occasional crackdowns on people who, the billionaires who get above themselves. Um,
Mm.
so again, is it, does it mean anything? Is it? I think it's largely performative. Um,
Yeah, I'm very curious as to how much money they think they're actually going to raise from this
yeah,
20% tax on offshore trusts. I've no idea what the volumes
that's
are
not
they
the
would see.
point. That's not the point. It's just
Well,
not fair.
but I think it came completely out of the blue, based on some
Mm,
trustees I've spoken to, out of the blue, and
mm,
it's also sort of
mm,
retroactive. So um, it's unusual in terms of a tax from that point of view. So they obviously, I think, had something in mind. Um, I I mean, I really can't think it'll be a huge revenue driver for them.
Mm.
But what I think it does do is adds to the general uncertainty of investing in and around China, mainland China, that is. I think Hong Kong's pretty good and pretty stable, um, although Hong Kong seems, yes, hand out tax breaks to family offices, hand out tax breaks to hedge funds.
Does it
Um,
need to do that? I mean, does Hong Kong really need to sort of go and have this sort of big bang in tax and cut taxes for financial firms in particular?
My
I
personal
think.
opinion is no. I mean, Hong Kong's a wonderful place and I love it here, but if you want to attract more people to Hong Kong, taxes are not what you need to sort of fiddle around with. We already do pretty well out of taxes. I think investment in sort of housing and improving the standard and quality of life for the residents, whether those are sort of expats that come in, or they are the locals. I think that's what um, would make things different, make it easier and more agreeable to come in and sort of do startups. I think, I mean, because from a visa point of view, I think it's really quite easy to get a work visa now in Hong Kong based on my experience in terms of getting people into Hong Kong that we've needed to. But you've still, yeah, they've got to find housing, sort of quality of life compared to wherever they're coming from.
Yeah.
Those are the things around the edges that I think the Hong Kong government should try and fix
Yeah.
rather than, again, tinkering with taxes.
John, I mean, what do you think about this? Obviously, it's
Yeah,
in the
I agree.
financial sector.
I think one of the not exactly one of the things about Hong Kong as a sort of financial center was back in the days when I first came here, although we had this very vibrant stock market, the actual capital formation, that's to say that assets under management in Hong Kong were relatively small. And I think it's quite smart to have targeted this sector and to targeted, the build up of Hong Kong's asset management center, because that strengthens the whole system, whether it's buying government bonds or investing in stocks and whatever. And to that extent, Singapore has had a lead for a long time. So they're trying to turbocharge that. Let's say that this is one of their, can't remember how many key goals they've got. This is one of them, isn't it? To make Hong Kong the most important wealth management center in a global wealth management jurisdiction.
Well, look, sadly, we've run out of time. I enjoyed that discussion. Thank you very much indeed. You heard there John Schofield, who is Managing Director of Tempus Investments, and Simon Kavanagh, who is partner at BDA Partners. It's a Wednesday morning, which means it's time for our regular view from Japan. Joined this morning by Tokyo-based Japan strategist Nick Smith. Morning, Nick.
Good morning to you.
Now, what on earth is happening with bond yields around the world? We're seeing, particularly in G7 countries, bond yields surge in the US, 30-year yields 5.3% now. Also climbing very fast to multi-year highs in Germany, in France and the UK, and of course in Japan. The 30-year yield at 4.14% yesterday, close to a highest ever. The 10-year yield approaching 3%, which will be the highest since 1996. Now, is there a common theme that links all of these countries together, or is it different things in each market? What's going on that is driving these yields to multi-year, multi-decade highs in some cases?
Well, yeah, I mean, obviously, inflation is the issue everywhere. Nowhere has really come to grips with the inflation issue. We've got to be really careful about it in Japan. So the last producer price index was over 7%. And there's obviously a concern that that's going to result in higher consumer prices later on in the year. But I mean, everywhere, central banks have been a little bit slow about and restrained about raising rates. Japan has been repeatedly accused of being behind the curve. I absolutely concur with that. And I think that swap markets are suggesting that we'll probably get 2 hikes between now and the end of January, with one almost certain on the 18 September meeting.
The BOJ's got to get on with it, hasn't it? It's the only G7 country with negative real interest rates, so it is way behind the curve, isn't it? So presumably one rate hike is not going to be enough. If they want to stabilise the yen, there's going to have to be maybe 3 or 4 in quick succession, I would have thought. Not that the BOJ is going to do that, but nevertheless, surely it's what's needed.
I'm not sure about that. I mean, I think that swap markets are suggesting we'll get 2 by the end of January and 3.5 by April time. So I think the expectation is that they'll raise rates. If they want to do so, then they've got to do it reasonably fast, because the Prime Minister is intending to swap out a number of people on the board of the Bank of Japan, and that would be probably putting in more reflationists who would like to hold down the rate of rate rises.
Does this all put in jeopardy Takichi's fiscal plans? I mean, she wants to spend a lot of money, doesn't she? She hasn't said how that's going to be paid for. Presumably it's going to have to be paid for with borrowing at these higher rates.
Well, I don't think she's got that much trouble with it at the moment. What people tend to forget about this, they say that rates have gone up in Japan. Those rates have gone up in Japan particularly because the BOJ slashed the bond buying program. But you've got all these people globally saying, well, Japan's got a lot of debt. And what they're missing is, but look both ways before you cross the road. Japan's net debt is much lower than its gross debt, and that net debt has been coming down. So it peaked in 2020 and has come down until it's almost the same as US net debt. And so its ability to pay for it is not much of a problem. So people are worrying about it, and I think it's mostly people outside Japan, whereas the debt situation is much more stable if you understand it from the point of view of interest costs not being that high, of foreigners not owning its debt, and so on. So what the Prime Minister has promised to do is to cut consumption tax on food from 8% down to 0. I mean, what she's really doing is 8 to 1, and then give some subsidies to mid and lower income families, and that's going to cost her about 5 trillion yen a year. But surely what we're seeing is such a rate of inflation that tax receipts are doing very nicely, thank you. So I don't think she's going to have a problem paying for it, but there are a lot of bond vigilantes overseas who are worried about it because they haven't done their homework on the Japanese bond market, I feel.
And of course, Japan has a lot of assets overseas as well, which is on the other side of its balance sheet. I've even seen people talking about Japan heading for bankruptcy. I mean, that's pretty ludicrous, isn't it? Japan can borrow in its own currency to start with, so no country that borrows in its own currency is going to go bankrupt. But the situation is not as dire as that, is it? I mean, it's costs.
Oh, absolutely not.
Servicing costs are going up, but they're not presumably unmanageable.
No, so the interest costs to GDP of the US are around 3.5-4%, and for Japan they're about 1.5%. But then you got to remember that that Japan's odd in that it has very different net and gross debt, and it can't help but make better returns on its assets than it pays on its debt, in which case its net interest costs are very low at about 0.5% of GDP. So it's certainly a very long way away from having problems. You listen to those people talking about Liz Truss events, which is an easy shot. But then the point is the foreigner owns about 7% of Japanese debt, so they can think what they want. But they're not really what this is about. What this is about is Japan has been, until very recently, the world's biggest net creditor. Because of currency rates and so on, that's not quite the case at the moment, but it has very significant assets overseas which are producing very nice returns. So the cost of its debt is not really an issue. I think the reason that people talk about this is to say, but its debt service costs are very high. And there was an FT article saying they're 31 trillion yen. And I couldn't help laughing at that, saying that's a beginner's mistake, that Japan quotes the repayment of principal in along with the interest. And of course, there's lots of repayment of principal, but it's refinanced. And so Japan's numbers are very, very different. And really, its interest costs are about a third of that, about 10 trillion yen. Even including the large buffer that the Ministry of Finance puts into its numbers. So Japan is, in a number of ways, more difficult to understand. It calculates its net debt is an odd issue that people don't understand. Its foreign holdings are different, and so on. And I think this simple battle that people are saying, Japan's got a lot of debt, doesn't understand that it's much more supportable than most people outside the country understand, just because they haven't been concentrating on the Japanese economy for a long time and they haven't done their homework.
I mean, there is another concern, and that is, of course, it's not just governments that are having to borrow. We now have a huge amount of corporate borrowing to fund all the capex that's going on among these AI hyperscalers. I mean, we're talking about enormous sums here, aren't we? Is that a concern that now as these rates go up, I mean, these companies are burnt through cash, turn their cash flow negative in some cases now? How big a concern should that be?
Well, that's an issue in the US. It's not an issue in Japan. I mean, obviously, Japanese companies have very large amounts of net cash. So, a bit under 40% of Topix non-financials have net cash and most of that is net cash of over 20% of equity for a lot of those companies, and so. Companies have got more cash than is good for them. Households have got more cash than is good for them, in which case the country as a whole would probably benefit from slightly higher interest rates. Certainly corporates and households would, and the country really isn't, the government debt isn't the payment problem that most people think it is.
It's odd, isn't it? Because it wasn't that long ago that Japanese companies were being criticised for having too many assets, having too much cash on their balance sheet. It ought to be returned to shareholders. At the moment, having cash on your balance sheet in this type of environment is not such a bad thing.
It's not such a bad thing, but obviously they need to put this cash to work. So still there are way too many companies with way too much cash. They need to put it to work and get, the point is we need to get return on equity up, which is sort of 8-9% in Japan, whereas it's 20% in the US. I think that it should be reasonably easy to take Japanese returns up to European levels. The point is how long it takes to get them up to US levels. The government, particularly Takaichi, is extremely frustrated about the companies failing to use this, and she's saying, well, fine, you've already raised the dividends, you've done share buybacks. Now raise wages and increase capex. And of course, as we saw a couple of days ago, it was the lack of corporate spending, lack of capex, that was one of the things dragging on GDP growth.
Now, one of the global concerns where this all intersects with global markets is that the Japanese yen is the funding currency, isn't it, for global assets, hedge funds, traders, borrow in yen, convert into US dollars, and that's been a big driver, all of this cheap funding behind the liquidity that's going into global markets. Are we at the point now where that is going to start coming to an end and maybe even unwind, and we're going to see the end of the carry trade, and what sort of impact is that going to have on global capital flows?
Yeah, I mean, that issue has taken longer to emerge than you might have expected. People assume that Japan would get rid of its deeply negative real rates, and it's certainly been taking its sweet time over that. But ultimately, Japanese rates will come up. The carry trade will unwind. A lot of people misunderstand this. When the carry trade unwinds, it's going to hurt the rest of the world, not Japan. It's the flows out of Japan that have driven up overheated equity markets and some of the bond markets, particularly in Europe. So I would watch for French and UK bond markets to have trouble, and probably also the overheated parts of equity markets will get some trouble from this. And so careful what you wish for. The US has been intervening in the Japanese currency market, but once it starts to appreciate, then the risk is it turns into a roar as money comes back to Japan, reverses that yen carry trade, and causes knock-on effects for the rest of the world.
Yeah, the liquidity comes to an end. Are we at the point now where it is starting to look worthwhile repatriating assets back to Japan?
The Japanese government has given an undertaking not to use not to sell off US treasuries, but it certainly can't stop everybody else from doing that. whether it's mom and pop or whether it's the institutions. I think money's going to start to come home as rates start to normalise in Japan. So by the time we're getting to January next year, when we've had a couple of rate rises in Japan, then Japanese markets will look a lot more attractive for repatriation, and that'll cause global repercussions.
I mean, where do Japanese equities fit now into the global picture? US equities looking very extended and overheated, although they have had a good earnings season, but nevertheless, we've had this huge sort of rise. If we do start seeing money start repatriating back to Japan, presumably this is good for Japanese equities. It's the rest of the world, as you say, that's got to watch out.
I think that's the case, that Japanese equities are certainly not overpriced at the moment. The earnings numbers for Japan are coming in quite nicely. Now, obviously, the issue with the US is the hyperscalers spending vast amounts of money with not terribly differentiated models there. So lots of people spending money on the same thing, and questions whether people are going to pay up for it. Whereas in Japan, the benefits from this are coming from picks and shovels for the gold rush, and the result is they don't care whether people make money or not out of the hyperscalers. Certainly for a while, the capex spending will go on, not just from the Americans, but possibly also everywhere else.
And finally, what about the Japanese economy? We had data out this week. Real GDP grew 1.1% annualised. That's well below the 1.9% in the previous quarter. Missed expectations quite sort of badly. Does this complicate things for the BOJ just as it's trying to raise rates, or can it look through this and say, look, we still need, rates are still at levels that are very stimulative. We need to raise?
The BOJ has been trying to use the argument that growth is not strong enough to raise rates. And I continue to say, no, growth is weak precisely because of your policies. So what we have as weakness in the economy at the moment is yes, capex, but particularly domestic consumption, which is broadly where it was before the global financial crisis, never mind before COVID. And so I think the problem there is that we've got inflation above the rate of wage growth holding back consumption. So get those wages up, get inflation down. It is the BOJ's fault that inflation is so high and holding down consumption. Don't use that as an excuse.
That's Tokyo-based Japan strategist Nick Smith.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow, where my guests will be Andrew Ferris, the CEO of Econosis Advisory, and Tim Huxley, chairman of Mandarin Shipping. And with a view from Taiwan is Ross Feingold, director of research at Cyrus Consulting in Taiwan. Please catch me tomorrow.
Money Talk